Welcome back to the Noob Selling Options channel. So glad you're here today because, well, we're tackling something every single trader faces, but honestly, nobody really wants to talk about. Today's explainer is a full-on deep dive case study into surviving a trade that just aggressively goes against you. We're going to pop the hood on a real trade repair and break down the exact anatomy of managing a crisis. Look, basic options theory is great when the market is actually behaving, right? We all love those perfect textbook setups. But today, we're diving straight into the actual mechanics and the mindset you need to manage a real, heavily tested position. We're talking real numbers, real execution, and the very real emotional discipline it takes to weather the storm. I mean, picture this. You've set up your short strangle, everything looks perfectly balanced, and then suddenly the underlying stock, in this case SNDK, just goes on an absolute tear. It literally goes parabolic against your trade. Your short call is suddenly under massive, massive threat. So what do? Do you panic, close it out for a huge loss, or do you methodically repair it? That exact conflict is what we're solving today. So here's our roadmap for this explainer. First, crunching the real numbers. Second, defend, finance, and recenter. Third, the option seller's mindset. And finally, mastering time and volatility. All right, section 1, crunching the real numbers, the receipts. Okay, let's jump right into my trades. What you're seeing here are the official broker receipts showing the 4 executed option legs we used to roll the 2 legs of our short strangle. Now, just a quick refresher. When we say rolling, mechanically it just means we buy to close our current position and simultaneously sell to open a brand new one. So we closed out our threatened February 2027 1470 call, and we closed out our highly profitable July 2026 530 put. Let's deconstruct the math here, because it brilliantly shows the balancing act of a trade repair. Starting with the call side, buying back that threatened in-the-money 1470 call, yeah, that was painful. It cost $26,442 to close, and we only collected $24,358 for selling the new 1570 call. So that's a net debit, or a cost, of $2,084. But flip over to the put leg. That massive bullish rally meant our 530 put lost its value, which let us buy it back super cheap for $1,804, while selling a new 550 put further out in time for $4,540. Boom! That gave us a massive premium credit of $2,736. And here is the punchline. When you combine that massive credit from the put with the painful debit from the call, we improved our strikes on both sides, gave the trade 100 points of breathing room on the upside, and still walked away with a net positive $652. We literally got paid to rescue our own trade. How awesome is that? Moving on to section 2, strategy, defend, finance, and recenter. So why did I do that? Well, the textbook rules for repairing a tested strangle happen in 3 exact steps. Step 1, defend the tested side. Because the stock pushed higher, our call was the one threatened. We rolled it up 100 points in strike just to give the stock some room to breathe. Step 2, finance the repair. Buying that safety on the call, it costs money, so we rolled the untested, winning put up and out in time to collect enough premium to actually pay for the rescue mission. And step 3, recenter the strangle. The absolutely crucial point here is understanding how our risk profile shifted. Our old position had become heavily short biased, meaning negative delta, because the stock soared so incredibly fast. We were just unbalanced. But by moving the put up 20 points and the call up 100 points, we effectively chased the stock's new, higher price. This recentered our risk right around where the stock is currently trading, bringing our overall delta back much closer to neutral. Which brings us to section 3. The psychology, the option seller's mindset. Now let's talk about the psychology behind my movements. The overarching philosophy to making all of this work requires emotional detachment and contrarian patience. Look, when a mega cap tech or AI stock goes on a massive run, retail investors usually completely panic. They succumb to FOMO, the fear of missing out, and start buying aggressively at the absolute top. But as a successful premium seller, you have to remain completely, ruthlessly detached from all that emotional frenzy. It's like this. On one side, you have the retail gambler. They're out there chasing trends, fueled by pure adrenaline, panic buying, and paying wildly inflated option premiums. On the other side, you have the casino, and that's us. We're taking the other side of those emotional extremes. We act like the insurance company. We know that trees just don't go to the sky and that market euphoria is totally unsustainable. By systematically adjusting our strikes and just waiting, we let the market's irrationality completely exhaust itself. All right, section 4, the engines of wealth, mastering time and volatility. So, there are two invisible forces powering this. The first is the volatility crush, driven by Vega. During a massive stock rally, hype and fear drive implied volatility through the roof. Options get incredibly expensive. But eventually, the news cycle cools off, earnings are digested, and all that euphoria fades. When that happens, IV contracts rapidly. And because we are short the options, this drop in Vega literally drains the extrinsic value out of the contracts, letting us buy them back for a fraction of the price later on. The second force is time decay, or Theta. You know, options are decaying assets. Every single day, they lose a little bit of value, kind of like an ice cube melting in the summer sun. When we rolled our put out to September and our call all the way out to February 2027, we bought ourselves an immense runway. Week after week, time decay is going to slowly, relentlessly eat away at the premium of both of those contracts. And honestly, this brings us to one of the most powerful concepts in this entire explainer. Time pays you. Unlike option buyers who are constantly fighting the clock, just praying for a massive directional move before expiration, you're doing the exact opposite. By rolling defensively and setting up a wide runway, you've positioned yourself to get paid literally just to be patient. You just sit back and let the clock do the heavy lifting. So, let's pull all of this together. The ultimate goal here is to build your financial fortress. And you do that through mechanical discipline, not guesswork. If a trade goes against you, you defend mathematically. You harvest the profits from the untested side to finance your repairs. You position yourself to capitalize on those inevitable volatility crushes, and you give yourself enough runway to let time decay work its magic. This is exactly how you compound wealth steadily instead of blowing up your whole account on a single bad day. If you found this explainer helpful and you want to keep building that mechanical, detached financial fortress with us, make sure you hit that like button and subscribe to the Noob Selling Options channel. We're constantly breaking down the real mechanics of premium selling here, so you can trade smarter, not harder. I want to leave you with this final critical question before you place your next trade. Are you trading like the gambler, chasing the emotional highs and panicking at the lows? Or are you operating like the house, relying on math, time, and mechanical discipline to ensure you win in the long run? Really think about that. Thanks for joining me on this explainer, and I will see you in the next one.